This is Chapter 11, Video 1. Let's launch. Today's learning objective, we're going to calculate the amount of gain or loss recognized on the disposition of assets on a trade or business. And so when we talk about dispositions, okay, so we've talked about in previous videos about how we purchase an asset, how we bring it in, and then we go ahead and we depreciate it over time. But at some point, you're going to go ahead and you're going to have to sell that asset. And if you have to sell that asset, what's going to happen is that there's a calculation that gets done because it's not like traditional income. So, for example, you come to work at my company and I pay you money, that's going to be your taxable income. There's really not a whole lot of stuff that you can do against that, especially under the new tax law where they got rid of a lot of unreimbursed business expenses. But when it comes to selling property, it's not that crystal clear. So if I have a piece of land and I sell for $400,000, that's not the exact amount I'm going to get taxed on. Again, that's amount realized, but that's not necessarily the amount that's going to be recognized, going back to what we talked about in our previous videos about income realization versus recognition. And so one of the things that we kind of talked about in the income recognition versus realization is the fact that, look, I'm not going to get taxed on my tax basis because that is using post-tax dollars to purchase it. So if I go out and I purchase a piece of land and I buy it for, say, $200,000, I have used post-tax money to buy that, unless there's some exception that I used under a deferral regime where I purchased it using pre-tax dollars. In that case, I wouldn't have tax basis. But because I use post-tax money, that generates tax basis. So when I actually sell that asset, I don't have to recognize gain on the amount of money that I receive that's equal to the amount that I already put into it. So in the first part of this, we're going to talk about the amount realized. Now, again, this realized is similar to the concept of realization that we spoke to before. It's the amount that you get from the sale of an asset minus everything that was required in order to sell that asset. And this is where I think sometimes when people start doing property transactions for the first time in the firm, this is where they get a little confused. You know, what sort of costs get added to the basis and what sort of costs get reduced from the amount realized. Now, from a mathematical perspective, if I increase the basis, but instead of reducing the amount realized, there's not really much of a change. But it is important because sometimes what will end up happening is that gain recapture, as we're going to talk about here later on, is subject to the amount of your tax basis. So if you accidentally take the wrong costs and add them to your basis instead of subtracting it from realization, you actually can run into some problems. So the seller's expenses is really the primary thing that you're going to subtract from this, and the seller's expenses is going to be things like, you know, agent's fees. So like if I sell a piece of land, I probably have to hire a realtor. The realtor is going to charge me a commission. That's a selling cost. If I pay for the buyer's side of the commissions, that's still a selling cost, even though it's comes from the buyer, but it's still going to be considered a selling expense on my part, because maybe in order for me to get them to buy it at the price that I want, I'll be like, hey, look, I'm going to take care of all your selling costs, or all of your buyer's costs. Don't worry about it. I got that. And so those things are going to get added into the selling expenses, which of course is subtracted from the cash realized or cash received. Now you see here where it says plus fair market value of other property plus buyer's assumption of liability. So the fair market value of other property. So say, for example, I sell a piece of land and I sell it for $400,000. I bought it for $200,000, but I sell it for $400,000. Person I'm going to buy it from or that I'm going to sell it to doesn't have $400,000 of cash, but they have another piece of land that's nearby, and they said, look, I bought this land, say, a year ago at $100,000 because it's all trees. There's nothing really improved upon it. I have $300,000 of cash, but what I'm going to do is I'm going to go ahead and I'll give you this piece of land that I think is worth about $100,000. I go and I appraise it. It's worth about $100,000 because it's unimproved, hasn't been touched really much. So I kind of say, okay, good, I'm going to take that. So that's the fair market value of that property. They'll get added as part of the amount realized. And of course, the buyer's assumption of liabilities. So say, for example, that same piece of land, I bought it for $200,000. There's still $100,000 of debt on it. And then what ends up happening is that I want to sell the piece of property for $400,000 because what I'm going to do is I'm going to take the $400,000, pay off the loan, and then I'm going to take my $300,000 and run. Well, what ends up happening is if the buyer comes back to me and says, look, Kevin, I don't have $400,000. I have $300,000, but I noticed that you've got a note on this for $100,000. I'll take over your debt, give you $300,000, and we can call it even Steven as part of the deal. And we can go ahead and we can do that. And so if they assume my $100,000 of liability, that gets added as part of the amount realized because I received debt relief. Again, a property right is moved in addition to a property obligation. You know, we talk about transfer of property rights as kind of being the amount realized, but it also can be a reduction of those obligations. And if you think about it, I become $100,000 richer because I don't have to pay it back anymore. I all of a sudden have something that I can use this with that works out very well for me. So we're talking about amount realized. Now, look, I've been doing this for about 20 some odd years. 99 times out of 100, the thing that you're going to be dealing with is how much cash they get, what did they pay for seller's expenses. That's going to be 99% of what you're going to deal with. Periodically, you're going to have this fair market value of other property and then the buyer's assumptions, and usually that's what makes the whole thing interesting. So the adjusted basis for determining gain and loss, again, I have a piece of land and I bought it for $200,000. So that's going to be my initial tax basis. Well, in accounting, we don't depreciate land. So now, say for example, instead of that land being at $200,000, we'll say the land is at $200,000, but I bought a building to go on top of it for another $200,000. And now I'm going to sell it for $600,000. That building that's on that land is going to be depreciated over time. Okay. And we talked about this in the previous class. We'll say that it's a residential rental unit. So I'm going to depreciate it over 27 and a half years. Say I've owned it for about 10 years. So, you know, there's going to be a cost basis that gets calculated for that. And, you know, we'll just say, just to keep the math easy, we'll say that, you know, I put $100,000 or $200,000 of the building. We'll say $75,000 of it's been depreciated already. So what'll happen is that I have $200,000 for the land plus $200,000 for the building for $400,000 minus $75,000 of depreciation that I took. Now, you'll notice on the back end of that, it says cost recovery allowed or allowable. If you don't depreciate your property correctly, the IRS is still going to tax you on the allowable amount, not the amount that you actually took. So what you have to do, and this is something that we do with a lot of our clients, is that we'll take a look at, okay, how much depreciation should have been taken? How much depreciation was actually taken? And if there's a delta, we have to go with the higher of the two. Okay. And that's going to be something you're going to have to do as as a person who does some analysis when they're trying to help your people build up and figure out what their cost is. Now, there is a remedy situation on this. So, for example, say I didn't do any depreciation at all. They come back and they look at it and say, Kevin, you should have been depreciating about $75,000 on this building, and you didn't do that. There is actually a remedy that you can do. We talked about this in the accounting periods class, where we talked about change of accounting methods. And you can file what's called a 3115 and tell the IRS, hey, mea culpa, client made a mistake. Actually, they're going to file this as a client. So the client's going to say, I made a mistake. I didn't depreciate like I should have. I want to take that depreciation right now. And you can get a 481 subsection A adjustment that'll allow you to take that depreciation in the year of disposition. I don't want you to think too much about that right now. That's just kind of me telling you. You know, the question is, if it's allowed or allowable, is there a way to fix this? And the answer is yes, but it is a long process. I'll tell you, at my firm, we charge almost, in many cases, we actually charge more than the actual preparation of the return is to get this done, because it's a very highly specialized, a highly technical document that needs to be done. There's a lot of research that has to go into it. And it takes a lot of time. But usually, you know, what we'll do is we'll take a look at it and we'll say, look, I'm going to charge you, we'll say $1,000 to do this form. But in doing this, your taxes are going to go down by $6,000. I mean, you know, the client at that point is usually like, yeah, I'll do it. And I'll pay you $1,000 to get this done. And usually what ends up happening is we're allowed to move on going forward from that. Okay. So the realized gain or on the disposition, this is where you got the amount realized minus the adjusted basis. And this, you know, usually when I'm in the class, and I'll write up a formula that just says AR minus AB equals G/L. AR minus AB equals G/L. And that's something you probably want to have if you're going to be doing your, when you're doing your test, is you want to make sure that you have that on your little notes that you're going to be able to do. I know the tests are going to be open book, but don't let that stop you from doing preparations for the test. Okay. Again, it's open book, open notes. I don't care. So my recommendation is make sure you've got your cheat sheet set up correctly so that you can go ahead and get that taken care of and do it efficiently on the test. Excuse me. Exhibit 11.1, summary of formulas for computing gain and loss. I'll let you go ahead and take a look at that. The gain loss, again, is going to be amount realized minus adjusted basis. And the amount realized is going to be what it is up there. And then the cost basis, the adjusted basis is that. This is pretty much it in a nutshell. And I've said this a couple times. Hopefully I've talked to you guys about this in the office hours. Individual tax return preparation is very loosey-goosey. There's various rules. They're kind of all over the place. They're not, after you've done them for a while, you'll actually memorize them and you'll get kind of a theory on it. There is an overall theory about how individual tax returns should be done. But for the most part, like I said, 47% of the revenue comes from individual tax return individual taxpayers. So, how they change those rules in order to affect, and again, we talk about this in the first class. Politicians like to do things, have their tax rhetoric come out and they're like, okay, we're going to go ahead and we're going to change these things. The majority of the changes usually happen in that area, and it kind of makes this loosey-goosey hodgepodge of mess that we have as the individual tax return system. You're going to notice with property transactions, this is a very mechanical, logical process to be able to get a lot of this stuff done. Investments, same thing. I bought it for this. I sold it for this. This is my gain. These are the rates I pay. And it's very mechanical. It's also very arbitrary in some cases. Is a stock held for more than a year considered a long-term hold? I mean, that's what the IRS says, but there's an old thing that they used to say in Taoism, that all adjectives are relative. I'm not tall. I'm only tall because I got people next to me that are normally shorter than me. That makes me a tall person. But if I go to an area where 6'4" is the normal, I'm not tall. I'm just normal. So that's kind of the way this is. I would say, property transactions are very mechanical, very logical, and as long as you memorize the formula and you use the formula, I don't actually memorize this too much. I mean, I know it just because I've done it so much. But if you know this formula, it's going to be a pretty easy process to get stuff done. Okay, 11.2. This is going to be this is tenants' asset dispositions, realized gain or loss for tax purposes. This is an example that I actually that we kind of talked a little bit about. But and here's the thing, folks. In the office hours that we do, if I haven't done it already, again, I'm shooting these videos in the summer. But if I haven't done it already, I'm going to share with you an Excel sheet that I've actually developed that we use here at the firm to calculate gains and losses on dispositions of assets. Okay. So when we're calculating how, things get calculated with regards to, amount realized, initial basis, all that other stuff. And then later on, when we talk about 1245, 1250, there's a good mechanical spreadsheet that I've developed, and I will share that with you. And then you can use that on the test. I don't have a problem. I mean, in fact, I would prefer you use it on the test because it's easy for me to read because that's what I look at day in and day out. And it's also, it's very similar to a couple spreadsheets that I've used in previous firms when trying to sit down and calculate all of this stuff. All right. So recognize gain on loss or disposition. Again, gains or losses that decrease the taxpayer's gross income. You must immediately recognize the vast majority of realized gains and losses that may be allowed to permanently exclude the gains from taxable income. Okay. So determining of the adjusted basis, so the initial adjusted basis, there's a lot of various ways that we can actually do this. So one of the big things that we have to deal with, of course, is, the initial basis. How do we determine the initial basis? And I told you, I went out and I bought a piece of land for $200,000. That's my initial basis. How much cash I put. But what if I didn't get it by purchasing? What if it was given to me as a gift? What if my father said, you know, son, I've got this piece of land. I can't deal with the taxes anymore. I know you're doing really well as an accounting professor and owner of your own firm. I want you to have this land so that you can take the cost off me. What's going to happen is that at the date of gift, if the fair market value is greater than the donor's basis, then the donee's basis is carried over basis. So if my dad bought it for $50,000 and gives it to me and it's worth $200,000, I'm going to have the basis, basis given is basis received. That's a phrase you need to probably also have in your brain box here. Basis given is basis received. Basis given is basis received. We'll change it. Basis given is basis received. Basis given is basis received. Okay. That's usually what I do in class. And actually, normally when we have a live class here is I ask everyone to chant it because that's what you've got to understand. That is a phrase that is prevalent through the tax system. And if you understand basis given is basis received, you'll actually have that. And that's usually what's going to happen in case one. At case two, if the fair market value is less than the donor's basis, the donee will use the carryover basis. If the asset is later sold for a gain, is sold for a loss, then it'll use the fair market value. This is where it gets a little tricky. Generally with property transactions, we don't have to worry too much about this. But if you think about it, so my dad has, he bought a piece of land, we'll say for $50,000. Come to find out later on, some yo-yo decided to dump a barrel of Hanford nuclear waste on it. Now, all of a sudden, that land goes from $50,000 down to $10,000. And he gives it to me. And I'm kind of like, gee, Dad, friends like that who needs enemies, right? But he gives me this land, and it's worth $10,000. Now, if I go in and I clean that up, by the way, a cleanup would actually be in addition to basis, but for 5 seconds, assume that's not the case. I go clean the land up. And, I spend $30,000 cleaning the land up. And now the land is worth, it was worth $50,000 again. I hold it for another 20 years. And then I sell it at $200,000. I will have sold it later on at a gain. Therefore, I have to use the carryover basis that my father gave to me. In a different scenario, say I don't clean it up, and I'm like, okay, that's fine. Dad gives it to me, and I'm like, I don't want to deal with this, so I'm just going to go ahead and sell it. And I sell it, and I can't get rid of it, so I go ahead and I sell it for $5,000. Again, his $50,000 basis, I sold it for a loss, $50,000 minus $5,000. I now have to use the fair market value that he gave me in order to do this. Now, in this case, I would still have a loss, because fair market value, as determined at the time that he gave it to me, was $10,000. And I couldn't get rid of it because once news came out, the value just kept going down, 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 down. So now that I've gone ahead and I've sold it, I have to actually use that fair market value number instead. Inherited property. This is actually a more common. Because, property transactions, generally what's going to happen is you're either going to buy it or you're going to inherit it. Very rarely do people give property. There may be people who unintentionally give property, but there's not a whole lot of people who do it. And you're kind of thinking, how do you unintentionally give property? I had a time once where what they had done was, they had mother and father were alive, dad dies. Mom's living by herself. Mom can't afford to keep up with the house. So what they do in order to facilitate transfer, as they said, mom says, I'm going to put you on the deed. What's happened? You've effectively done a gift. Okay. Again, there's not an intention to do a gift, but they wanted to put son's name on the property so that if mom passes away, son picks it up immediately because there's nobody else on the deed. Her half will go through probate. But generally, son can do whatever he needs to with the house immediately because he's on the deed. So in those cases, you've effectively given a gift. Now, getting back to this inherited property, say they go talk to their CPA and the CPA says, no, don't do that. You can give them property rights. You can give them a power of attorney to work on this in the behalf of this in case you want it to happen that way. That's fine. But until you pass away, you don't want to hand this to them. So they say, talk to CPA, and they actually listen to the CPA. These are miracle clients. They actually listen to what we tell them to. What ends up happening here is that your inherited property, basically what'll happen here is that your inherited property will transfer at fair market value to the decedent, to the beneficiary. Okay. Passing from decedent to the heir, it will go at fair market value. All right. Fair market value as of the date of death. You can use a 6-month date of death, But in order to do that, you have to file a Form 706. Now, I want you to understand a 706 is not an easy form to do. Audit rates in the audit field, audit rates in the estate, estate returns 706s used to be as high as 60%. Okay, so usually people who prepare 706s, they charge buku bucks. And if your estate is less than the estate exclusion of $11 million, there's generally no need to do one. And so as a result of which, oftentimes people don't do it. Now, there's a whole host of reasons why you still want to do it. I don't want to give an impression that by not doing a 706, it's always the right thing to do. There's actually a lot of reasons why you should do a 706. And in my personal opinion, if it's less than $11 million of the estate, the risk should be almost nothing because there's nothing to worry about, because once they find out it's less than $11 million, the IRS is probably not going to audit it anyways. But there's a lot of things that you can do with a transference, in a 706 that should actually encourage people to do one. I'll be honest, I haven't done one myself. I've never needed to do one. I've never had a client who's really wanted me to do that. But that's kind of how it's ended up happening. So determining adjusted basis, we're going to talk about converted from personal use to business use. Okay, so this actually happens to me sometimes. I buy stuff in my house for a long time. Very good example, all this camera equipment, all this computer equipment that I've had. I use it primarily for my own personal use, but sometimes I use it for business. I haven't actually converted it to the business. So for example, the camera that I'm shooting this on, the Nikon that I'm shooting on, I bought it for around $700, I think, $600, $700. I actually looked at, how much one of these would cost today because I was thinking about replacing it and all that stuff. And I actually looked it up. You can actually buy one on eBay now, I think, for about $250. Okay. So it's fair market value as of the date. So if I decided to convert that today, I bought it for $700. The fair market value is $250. I go ahead and I bring it in, and later on I sell it for $100. What is my basis in that thing? In the camera. And the answer is that because it declined in value, I'm going to have to follow number 2, which is the fair market value at date of conversion, which is the $250. And then when I do it, I figure out the loss. And what they're trying to do here is they don't want you to go out. Like, for example, I buy this camera, and then I decide that I'm gonna I notice it's not gotten a whole lot of value. I want to sell it, and I want to get a tax write-off on it. So I convert it to business use it for about 6 months, and sell it. The IRS doesn't want you doing that simply for the impression that you're going to get a loss on something. Now, if I buy it for the business, use it 100% for the business, and eventually sell it as a member of the business, that's a different situation. I'm not, the IRS is not looking that I'm doing tax games as a result of this. Okay. All right, folks. So that's all I've got for this video. I want to say thank you very much for showing up, and I look forward to seeing you at the next video.